Howdy, Jacob here. Today I'm going to do a more in-depth analysis on 3M. So before I go into it, I just want to make sure everyone knows that this will be my perspective on the present value of 3M given a 15% return. Please do your own research. Everything I say will be of my opinion. Agree, disagree, do what you want with the information. I'm hoping that you view this in conjunction with your own analysis, and I will just be going over a quick review of the financials and then some notes that I took away from the company and kind of the things that I look at when I look at a company's quarterly reports, 10Qs and 10Ks. So first, let's remind ourselves about the company a little bit. So it's a $53 billion market cap on $60.1 billion enterprise value. So they do have a little bit of net debt here. Return on invested capital is very substantial. So it looks like the money that they reinvest into the business, they get a very large return on that money that gets invested. We see that it has actually gone down, which is a negative, but it went from 22% in 2014 to 18% in 2022, only being negative in 2023 due to a large write-off of litigation charges, which I'll get into in my notes, which is, I think, a big reason that the company's stock price has gone down so heavily. But the business is relatively flat. We see 31.8 billion in 2014 to 32.7 billion in 2023. Operating margin was pretty consistent. Again, 2023 is a little wishy-washy, so they've consistently done about low 20% operating margins. And then gross margin has actually gone down a little bit from 48% to 43%, but in most years is pretty consistent in the mid to upper 40s. We see that they do have a little bit of net debt here, about 13 billion in long-term debt with 6 billion cash on hand, but they do produce on average about their 5-year average is about 5.5 billion, and so that their debt in relation to their cash flow is just under 2.5 years of their 5-year average free cash flow. So that's a very positive sign. And when I did my initial calculations, I got to a price that was within 4% of a buy price. And so some of the comments before going into my updated assumptions here, we have first, you can see that I have less notes than some of my other companies. My perspective is that the more kind of two things, the bigger a company is and the more consistent a company is, the less review you need to do on the company. And obviously, I'm not saying you don't look into the 10K, 10Q quarterly reports to get some information, but you don't need as much information on a $60 billion market cap company that's been extremely consistent for decades versus a $100 million market cap that's grown about 20-30% a year and is very volatile, could easily get consumed by another business. 3M is one of those companies that their sub-companies might get consumed by other businesses, but the business as a whole is going to be the one doing the consuming, if anything, because they have so much cash available to make those investments. And so to me, this company is very big, very consistent. I don't think I need to do as much review on it. And again, that's not saying I still didn't look into the last couple years of 10Qs, 10Ks, and then the most recent 4 quarterly reports. I still did. I just didn't care as much about some of the acquisitions, some of this, that, because I think that since the company's been so consistent, it's easier to rely on the historical data. And obviously, if there's anything big like their litigation on their earplugs, I did take that into consideration. But outside of that, there wasn't anything that was so substantial I think I needed to really point out here. So first thing is that the CEO comments were fairly specific, which is a positive. So we will continue to invest in high growth markets where 3M's unique capabilities can make a difference, including automotive electrification, climate technology, industrial automation. I'm confident we will deliver a successful 2024. So it's specific in the fact of they know you'll know where the growth is hoping to be, but we don't necessarily see what they're trying to focus on. I do prefer management, CEO, CFO that prefer to focus on free cash flow, which they did not point out in any of their comments of their last 4 quarterly reports. So I did want to note that although they're specific in saying where they want their growth to come from, they were not specific in free cash flow, revenue growth, earning. What are they focusing on? Margins. Um, so that's a positive that they were specific in one aspect, but negative in the fact of I like to see people that call out free cash flow as much as possible because that's what I love to see uh, and love and want the management to really care about. We see that the 2023 revenue was down about 4.5% compared to 2022, so a little bit of decline, which we're seeing in a lot of other companies. So not super surprising from that perspective. Net income was roughly negative 7 billion due to special expenses for their earplug litigation, but their free cash flow was still positive at about 5 billion. Their business segment by revenue is roughly 33.5% in safety and industrial, 26% in transportation and electronics, 25% healthcare, 15% in consumer goods. Their operating income for all 4 groups was over 15% in 2023, with safety and industrial being the greatest at 21%. So pretty great to see that their largest business segment is also their largest margin business, and that all 4 of these businesses have operating margins above 15%. So that's a very positive thing to see. And then our next note is that 8 billion of the 14.1 billion in long-term debt is due after 2028, with about a billion a year until then. So we see 2024 to 2028, about a billion a year roughly. Could be 500,000, or sorry, 500 million, 1.5 billion or so. But a majority of their debt is due after 2028, and so that leaves about $6 billion, and their 5-year average free cash flow is 5.5 billion. And so their debt, although their enterprise value is 7 billion greater than their um, market cap, we see that a lot of their debt is due after 2028 in 5 years or so, which is a good thing. That's a healthy balance sheet. And again, I wasn't even too concerned based on their 5-year average free cash flow being just about 2.5 years for their long-term debt. And then we see that the litigation on their earplugs, 3M will contribute $6 billion roughly between 2023 and 2029 for that settlement. And so you'll see that my final numbers on assumptions are pretty similar to my initial ones, except I am going to think about the cash flow to year 7, because obviously these are after 7 years. What do I think the assumption is going to be? So 1% a year in revenue growth. I increased the range of margins from just 16% to 14 to 16%, saying that the litigation charge is going to be going through, and in 7 years might still have like lingering effects. And just for conservativeness, I increased the range, and then I brought the share change down to 0.5% because I think that the 0.5% is every year, and I think that the litigation charges and debt are going to be a bigger piece of their free cash flow allocation. And then as well, I'm going to bring this down to just increase 1% a year, which will free up a little bit more money to be paid for their settlement. I do think, I mean, obviously 6 billion is not nothing to 3M, but in reality, it's almost like taking off a year of free cash flow, since their 5-year average free cash flow is about 5.5. So if you were to calculate it um, entirely without the earplug, and you just take off like 1 year of estimation, you're pretty much going to get to the value you think it is worth. And so to me now, I do think that these assumptions are fairly conservative, but I think that with everything I reviewed, this would be the most comfortable thing that I would estimate to get me a 15% return. And obviously, my numbers can be more conservative, more risky than yours, but again, this is just my perspective. And so I hope you have Hope everyone enjoyed the video and has a great rest of their day. So thank you.